Welcome to the Deep Dive, and specifically to TalkTickers. We're the show that breaks down earnings calls to find the insights that really count.
That's us.
Today, we're digging into DR Horton, America's biggest home builder. We're looking at their third quarter fiscal 2025 earnings call.
Right. And our goal here is to really give you, our listeners, that sharp take performance operations, what they're seeing ahead.
Exactly. We want to arm you with the strategic stuff, not just the headline numbers. So let's get into what DR Horton is actually doing.
Okay, so the bottom line for Q3, they did well. I mean, really quite solid results, actually beating their own forecasts.
Which says a lot in this environment.
It really does. It shows a kind of resilience, strategic discipline, even when things are choppy out there.
Okay, let's put some numbers on that resilience. The results snapshot. What stood out?
Well, earnings were strong, $3.36 per diluted share.
Okay, solid start.
Yeah, and pre-tax income hit $1.4 billion. That's on $9.2 billion in revenue. So your pre-tax margin is sitting at 14.7%.
Pretty healthy margin. And closings.
23,160 homes closed in the quarter.
Right. And you mentioned beating expectations. I saw their home sales gross margin was 21.8%. That was above their guidance, wasn't it?
It was, yeah. And that's a really interesting point. Hitting 21.8% gross margin suggests they're managing costs and pricing really effectively, even with incentives in play.
It's that balancing act, right? Pace versus price, finding that sweet spot.
Exactly. Not easy to do at their scale, especially right now.
So let's dive deeper. How did the core financials break down?
Okay, so home sales revenue specifically were $8.6 billion on those 23,160 closings.
Which is slightly down from last year, if I remember.
Correct. Last year was $9.2 billion on about 24,155 homes. So a bit softer year over year, but context is key. Net income for the quarter was $1 billion.
And part of that context is probably the average selling price, the ASP.
Got it. The average closing price was around $369,600. That's down 1% from last quarter and 3% from last year.
Okay.
And the average price on new orders was similar, $365,100, also down a bit, 2% sequentially, 4% year over year.
Which sounds like a deliberate move towards affordability, maybe. Trading a bit of price for volume.
That's exactly how it looks. Prioritizing sales pace, keeping things moving by hitting those slightly more affordable price points, it's a strategic trade-off.
And did it work on the sales order front?
It seems like it. Net sales orders were basically flat compared to last year at 23,711 homes. But importantly, they were up 3% sequentially.
Flat year over year in this market isn't bad. Up sequentially is better.
Right. The value of those orders dipped slightly, about 3% to $8.4 billion, which lines up with that lower ASP.
Makes sense. What about cancellations? That's always a key metric for buyer commitment.
Still very low. Came in at 17%. Now that's up a tiny bit from 16% last quarter, but it's actually down from 18% a year ago.
So 17%. That suggests the buyer's sign contracts are pretty serious, well-qualified maybe?
I think that's the read, yeah.
Yeah.
Especially when you consider the incentive environment. Low cancellations signal that the demand they're capturing is solid.
Okay, let's shift gears to costs. SG&A selling, general, and admin.
Right, their overhead. It ticked up 2% year over year, landing at 7.8% of home sales revenues. That's up 70 basis points from the prior year.
What was management's take on that?
They actually beat their internal expectations on SG&A, attributing it mainly to the higher closing volume.
Yeah.
They're still targeting a long-term range of 7% to 8%, so it seems under control. Shows good cost discipline as they grow.
Discipline seems to be the word. How about capital allocation, cash flow, returns?
Yeah, this is where they really shine, I think. Generated $2.9 billion in cash from operations over the last 12 months.
Strong cash flow.
Very strong. And they put a lot of it back to work for shareholders. $4.6 billion returned via buybacks and dividends.
Wow, $4.6 billion.
Yeah. And look at the returns metrics. Home building pre-tax return on inventory, 20.1%. Consolidated ROE, 16.1%. ROA, 11.1%.
That return on assets number, 11.1%. I recall hearing something pretty striking about that.
You probably did. It ranks in the top 15% of the entire S&P 500 for the last 3, 5, and 10-year periods.
Top 15% for a home builder. That's exceptional consistency.
It absolutely is. Speaks volumes about their capital efficiency in a cyclical industry.
And they're backing that up with share repurchases, too.
Aggressively. They bought back 9.7 million shares for $1.2 billion just in Q3.
Okay.
Year to date, that's $3.6 billion in buybacks. It's cut their outstanding share count by 9% compared to a year ago.
That's significant. And they still have firepower left.
They do. $4 billion remaining on their authorization. And get this, they actually increased their buyback plan for the full fiscal year 2025, now targeting $4.2 to $4.4 billion.
Increasing the buyback plan now, that's a real signal of confidence, isn't it?
It's a huge signal. Confidence in their cash flow, confidence in their balance sheet.
Speaking of which, how does the balance sheet look overall?
Like a fortress, pretty much.
Yeah.
Ended Q3 with $5.5 billion in liquidity, including $2.6 billion in cash.
And leverage.
Consolidated leverage at 23.2%. Their long-term target is around 20%, so they're right in that zone. Gives them a ton of flexibility.
Flexibility to navigate, flexibility to invest. Okay, let's pivot to operations and market trends. What are they saying about demand?
Well, they're acknowledging it's choppy. No surprise there. Affordability issues, cautious consumers. It's all impacting things.
So incentives are up.
Definitely. They said they've increased them to drive traffic and sales, and they expect them to stay elevated, maybe even tick up more in Q4.
But the low cancellation rate suggests those incentives are working on the right buyers.
That seems to be the case, yeah. It's attracting buyers who are qualified and stick with the purchase. It's not just window shoppers.
What about the supply side? Starts, inventory.
They started 24,700 homes in Q3, which is a big jump, up 24% sequentially. They do expect Q4 starts to moderate a bit from that level there.
And inventory levels.
Ended the quarter with 38,400 homes in inventory. About 25,000 of those were unsold. But importantly, the number of completed unsold homes actually decreased.
So they're selling them faster once they're finished. Ties into cycle times.
Exactly. Cycle times improve a couple of days faster sequentially, about 2 weeks faster than a year ago. That helps turn inventory quicker, frees up capital faster. It's all about velocity.
Makes sense. And land. How are they managing their lot position?
It's a very capital-light approach, mostly. They control around 600,000 lots, but they only own about 24% outright.
So 76% are controlled through options or contracts.
Right. They rely heavily on relationships with third-party land developers. In Q3, 66%, two-thirds of their closings were on lots developed by others.
That boosts capital efficiency, less cash tied up in land?
Yeah, definitely.
Huh.
Though it's not without risk. They did mention $16 million in inventory impairments and $36 million in write-offs on land contracts this quarter. A reminder that land isn't risk-free.
Fair point. Are they still growing their community count?
They are. Average active communities were up 4% sequentially and 12% year over year. They expect that growth rate to slow down a bit next fiscal year, maybe mid to high single digits, more measured expansion.
Okay. What about construction costs? Any relief there?
Some, yeah. Stick and brick cost the actual materials, and labor were down 2% year over year and 1% sequentially per square foot.
Okay, that helps offset incentives a bit.
A little bit. Lot costs, though, moderated slightly sequentially, but are still up mid-single digits compared to last year. They expect stick and brick costs to keep improving slowly thanks to design efficiencies and better labor availability.
And that design efficiency, that ties into their product strategy, smaller homes.
Absolutely. Strong adoption of smaller floor plans. The average home close in Q3 was 1,956 square feet. That number's been gradually shrinking for years as they chase affordability.
Meeting the market where it needs to be met. Let's touch on their other business segments quickly. Rental operations.
Still a significant piece. Generated $55 million in pre-tax income on $381 million in revenue. That came from selling about 1,650 single-family rentals and over 300 multifamily units. They hold about $3.1 billion in rental property inventory.
And Forestar, their lot development arm.
Yeah, their majority-owned lot developer pulled in $391 million in revenue, selling over 3,600 lots, generating $44 million in pre-tax income. It's a key part of their lot supply strategy.
And financial services, the mortgage arm.
Very profitable. $81 million pre-tax income on $228 million revenue. It's a huge margin, almost 36%.
Wow. And what percentage of buyers use their mortgage company?
81%, a very high capture rate.
It gives them a lot of control and visibility.
It does. Average FICO score for those borrowers was 720, which is solid. Average loan to value was 90%, meaning about 10% down payment on average.
And lots of first-time buyers.
A big chunk, yeah. 64% of the closings their mortgage arm handled were for first-time buyers. They specifically mentioned attractive FHA rates, like a 3.99% offer, really helping drive that segment.
Yeah, a 3.99% rate would definitely get attention right now.
Okay, let's look forward. What's the guidance? Q4 outlook.
For the fourth quarter, they're expecting consolidated revenues between $9.1 and $9.6 billion. Homes closed forecast is 23,500 to 24,000. And margins. They guided Q3 gross margin slightly lower, right? So what about Q4?
Yes, they expect home sales gross margin to dip a bit further. landing between 21% and 21.5%. Consolidated pre-tax margin projected at 13.6% to 14.1%.
Okay, reflects those continued incentives. And the full year picture.
They bumped up the full fiscal 2025 guidance, now looking for consolidated revenues of roughly $33.7 to $34.2 billion and total closings between 85,000 and 85,500 homes, tax rate around 24%.
So even with the Q4 margin pressure, they're still raising the full year targets. That signals underlying confidence.
It does. Confidence in their execution, confidence they can navigate the choppiness.
Okay, let's pull this all together for an investor context. What are the key signals here?
Well, first, the consumer landscape is choppy, no doubt. Rates, economic worries. It's noisy. But DR Horton's incentives are proving effective at bringing in qualified buyers. That low cancellation rate is the proof.
They're not just buying traffic, they're buying committed sales.
Precisely. Second, competitive dynamics seem rational. DR Horton is adjusting incentives market by market, but they note competitors aren't panicking with broad price cuts. And resale homes aren't seen as a major threat because they're older and lack those juicy builder incentives.
Gives new construction an edge. Any geographic callouts?
Yeah, interesting tidbit there. Smaller markets, where they often compete more with local private builders, actually performed more consistently this year relative to their internal plans.
Interesting.
The Pacific Northwest was mentioned as a softer spot, potentially linked to tech sector uncertainty. Shows regional variations still matter.
And the long-term strategy remains consistent.
Very much so. Positive medium to long-term outlook, leveraging their scale, geographic reach, and focus on affordability. Disciplined capital allocation, improving returns, strong cash flow, that's the playbook. And they're doubling down on affordability with those smaller lots and floor plans.
Okay, final check. Headwinds and tailwinds.
Headwind, incentives pressuring margins. Tailwind, slight improvements in stick and brick costs, helping offset that a bit. Another tailwind, plentiful labor helping improve cycle times. Potential headwind to watch, Canadian softwood lumber tariffs, though the full impact isn't clear yet.
Got it. A complex picture, but they seem to have a clear strategy.
Definitely. Which brings us nicely to our not financial advices segment. The outrageous but plausible trade idea.
Okay, let's hear it.
How about this? Consider going long DR Horton stock, DHI, and pairing that with a short position against, say, a basket of smaller, less capitalized regional home builders, or maybe a housing ETF that's weighted towards them.
Okay, long the leader, short the weaker players. What's the core rationale?
It leans into everything we've discussed. DR Horton's huge buyback program, their rock-solid balance sheet, the consistent cash flow they're built to withstand pressure and even thrive. Their capital efficiency, using third-party lots, turning inventory faster, plus their ability to offer those really attractive mortgage incentives. It all allows them to consolidate market share from weaker players.
So it's a bet on divergence. The strong getting stronger in a tough market.
Exactly. It's a play on their superior execution, capital allocation, and market share gains driving potential outperformance, even if the overall housing market stays kind of choppy. A bet on the leader pulling away from the pack.
Interesting idea. Okay, let's wrap this up.
So to recap, DR Horton put up the strong Q3, showed financial strength, smart operational moves, and a clear plan for navigating the current market using things like targeted incentives and smaller homes.
And just a reminder for everyone listening, this conversation is purely for informational purposes. It is definitely not financial advice. Always do your own research.
Absolutely. Consider your own situation before making any investment decisions.
So, thinking about DR Horton's focus on affordability and efficiency, what does that signal to you about the future shape of the American dream, especially when it comes to housing? Where are buyers willing to compromise and where aren't they? Something to think about. We'll catch you on the next Deep Dive.